Skanda, which is, the first question I'm going to direct to Skanda, which is this. What are, from your point of view, the fundamental economic constraints that industrial policy needs to overcome, particularly in the context of the climate transition? What are the barriers to the required private investment? Is it just that private returns are too low, so that subsidies ought to be a sufficient solution? Or are there other problems that require public role, problems of financing, coordination across firms or industries, uncertainty, and so on? In other words, what is it that we would like industrial policy to do?
Sure, that's obviously a pretty weighty question to bite off. By the way, it's a really fun panel to be a part of. So I'm glad we could put this together. I think that the challenge of the energy transition, challenge of decarbonization, right? If you think about what you talked about in terms of the conventional wisdom of a carbon tax, was kind of this notion that if you put a certain price on carbon, keep it in place, substitution will happen kind of in the ether, happens over time, and that it left with that's all that really needs to happen. I think what has changed, at least in the thinking more substantively, is about it is an investment challenge. It's a capital stock challenge. It is what does it take to actually get the requisite capital stock to support decarbonized consumption? Because if we think of emissions, it is a production phenomenon, but it's also a consumption phenomenon. There's a demand for oil, gas, and coal across the world, and there has to be viable substitutes that are available. But those viable substitutes take both investment, which can happen or sometimes, but doesn't always happen, certainly left to its own devices. Hurdle rates interfere, all sorts of uncertainties interfere. But also there's a technological component to it, for certain aspects of the energy transition still are unsolved for, where it's going to be about standing up first of a kind, second of a kind, nth of a kind projects to actually be able to prove in a lot of different dimensions of emissions that some things are possible. So in some cases, the technological constraints are not fully solved for, especially when you talk about commercial scale. And so these types of uncertainties are where it's not a given that the government's balance sheet, public balance sheet, just being flexible enough is a solution. I would say it's a very valuable and powerful tool in the toolbox, but it's not a given that alone is going to solve every problem. And there's obviously, for every example of fiscal ambition leading to success, you can also probably find one where it led to a lot of inside dealing and what some might call corporate welfare and corruption. So there's like a governance component to it too, which is actually having an ability to learn from how investments are deployed, the ability to actually identify, are we achieving the goals we aim to achieve through investment? But I think that real sea change is around how do we use financing to do something more, right? How do we use the power of the government purse, at least in advanced economies, to actually do to actually become a more capable government over time, to be a more capable public over time. That I think is the underlying challenge, because there will be hiccups in the next 5 years over how IRA gets deployed, unintended consequences, things that did not play out exactly as planned. And when that happens, are the people within government, the people who are trying to set policy, able to learn from those mistakes in good ways that are able to better realign incentives, realign policies in ways that actually guide us to the desired outcome, which is to lower emissions, ideally the net zero goals that are laid out by the administration and by sort of Paris Agreement.
Great, thanks. So yes, so the question is why do we need industrial policy at all, or do we? Chirag, did you want to say something to that?
Yes, and thank you once again to the team at the Polycrisis and JFI for hosting this webinar. I'd like to add something to Skanda's discussion of investment. I mean, I think we have to get into a little bit as well what we expect of investment to do, and in certain cases, why investment is not happening at the requisite speeds or the requisite volume in the areas we would expect for decarbonization, right? So not just new generation systems, but new heating systems, industrial equipment, transportation equipment, and so on down the line. And here I actually want to dig into the writings of one of your colleagues, Skanda, which is Alex Williams, who's written a number of thoughtful pieces at Employ America on this, which note that investment in, take your particular sector, has a number of barriers associated with it. Just take energy projects, for example. And what these barriers do is that they prevent either the private firms or even public enterprises that might be undertaking it from getting out of that investment a stable cash flow that they can count upon and then make subsequent decisions upon, right? Translating a series of uncertainties and barriers into stable cash flow and stable gain over time. An example of this in energy projects is if you are trying to put up a new solar project or a new battery, but you get stuck in an interconnection queue, there's no risk premium that can compensate you for getting stuck in that queue. If your project doesn't get built, it doesn't generate income, which means undertaking that investment in the first place just might not be something you even attempt at the beginning, or if you start to attempt it, you might drop out, right? And that's just one barrier to energy generation. And so one of the ways I think we should conceptualize industrial policy and then evaluate it for whether it is doing what it is supposed to or not, which is spark new capital expenditure, is how is it addressing the various barriers to decarbonization of different sectors, decarbonization of different products, and is it opening up new capital investment opportunities either for private firms or for public enterprises? And the evaluation of these investment barriers is going to look different across various sectors. But I think it's important to hone in on that, both just as a definition of what industrial policy does, but also to, I think, avoid certain descriptions of industrial policy that may be missing its primary purpose.
Yeah, I think that's kind of at least framing the question in, I think, a very compelling way, which is that it's not simply about prices being wrong, but about hard barriers that you can't overcome simply by a subsidy or by changing prices, but you actually need to identify specific hard constraints and try to remove them. Of course, framing it that way is easier than actually figuring out where those necessarily are. Okay, so I want to move on to Daniela here. This is obviously a panel on de-risking, and that's probably a term in our world, at least, that's associated with Daniela more than anybody else. Daniela, you've described the approach currently being taken both in the US and perhaps even more so in Europe in terms of the de-risking state. And this is a category that you've sort of identified a number of characteristics of policy that kind of fits this model. It focuses on the production of investability. The fundamental problem is enabling or convincing private capital to take ownership of the assets we want them to take ownership of. It works primarily through price signals, by making obviously some investments more attractive, by reducing the returns in various ways. It shifts economic risk from the private sector to public balance sheets. It maintains the primacy of the central bank. And it's an approach that does not require or entail any kind of central coordination or planning. So that's sort of a broad, and I'm sure I've missed some of the characteristics you point to as well. It's kind of a broad basket of things. I wonder if you can take some time, and please take as much time as you need to kind of zero in on what specifically distinguishes what you see as a de-risking approach to kind of management of the economy from other approaches, and why you think the IRA kind of fits that description.
Thank you. Well, thank you first to the organizers. And let me start. I was going to start by reminding everybody that de-risking is not my term, but I just wanted to also draw attention to the fact that how you frame problems of decarbonization is also a question of, a political economy of de-risking. And to me, Chirac, for example, just now, framed the question of carbonization through a de-risking logic or a de-risking intuition, where the problems are risks to private investment, and you have to remove them not just by giving subsidies or tax credits, but you also have to do what the World Bank would describe as regulatory de-risking to make sure that the electricity company or the generating company is able to connect to the grid. So I would say we have to be careful how we frame things. And to me, I would start from a very different kind of, I would take a different starting point to describe problems of decarbonization, which is, with the climate crisis that we live in, and most people accept that we live in a climate crisis, private capital is engaged in systemic greenwashing. So from there, you have a very different diagnosis of what's happening. But I will go back to the question, and maybe Chirag, we can go back to having a conversation whether I heard you kind of framing things as de-risking or not. But I just wanted to make it very clear that although I have spent the last 2 to 3 years theorizing the de-risking state, I did not invent the term. It's not mine. I did not come up with it. Deutsche Bank came up with it. So please, you can chase Deutsche Bank if you want to. Deutsche Bank came up with it or introduced it in public discourse in 2011, when together with the United Nations Development Program, it argued or introduced the conceptual lens of de-risking to say, if you want to get renewable private investment in renewables in the global south, you needed to basically de-risk or to introduce regulatory and financial de-risking to escort private capital into those areas or into those public policy priorities. So this started at least in 2011. It was born in Europe as a kind of logic of statecraft. This is how I describe it. It's a political economy of a logic of state intervention. It's not just a simple description of a particular policy framework or a particular industrial policy approach, as maybe you, Josh, have done just now. It was adopted by the World Bank in 2017 when it introduced the Maximizing Finance for Development. Its president at the time used de-risking. He said we should de-risk countries, right? So it's not me. Just this is a very important clarification, right? What is interesting now is that we have moved from saying we should de-risk private investment, and particularly we should de-risk private investment of institutional capital like BlackRock and many other types of asset manager. We should de-risk their investments in social infrastructure and kind of SDG, Sustainable Development Goal kind of priorities in the global south. Now we are saying we should de-risk investment, or we should help capital or guide capital towards industrial policy priorities. That's the big shift, and that big shift comes with, to my mind, with the Biden administration. We had some debates, and we can continue this, whether China has been part of the story or not. I would argue not, in terms of what are the geopolitical factors that have put de-risking at the center of at least green industrial policy, but other types of policies. And what matters, and we will come back to this, how is de-risking different from other arrangements? In the paper that Tim just mentioned, de-risking to me is at its core setting a particular type of relationship between the state and private capital. And this is why it's important, I think, to resist the temptation to celebrate a paradigm shift. I don't see a paradigm shift if I read de-risking and if I read the US IRA as a macrofinancial phenomenon. What de-risking does is to say we have a plausible political narrative of action. We can, bring the Republicans and the Democrats together. We don't have to fundamentally change anything. We just need to put a bit more fiscal resources into bribing private capital to go into certain public policy priorities, but we don't have to change the relationship between the central bank and fiscal authorities. And definitely we don't need to reform institutional capital. We don't need to shrink institutional capital as we dreamt of doing after the global financial crisis. So that would be, to me, the important difference between de-risking de-risking as a logic of statecraft in industrial policy and early experiments with industrial policy. In the developmentalist literature, in the work of Robert Hunter Wade or Danny Roderick and many, many others, you find an element of discipline. You have to discipline private capital. De-risking at its core is not consistent with disciplining. And I will stop here because I can go on forever, but I don't want to take over.
So if I can...
Yeah, go ahead, Scott.
So I think you're right to highlight de-risking is a term that's used quite commonly in a lot of private sector parlance. It's certainly not something that is unique to, it is a term that's used, and it's a term that's used maybe in private sector parlance less pejoratively than probably, I think Daniela probably likes to use it. But I think descriptively, it's accurate. Like I actually have no problem with calling IRA something that is trying to do a lot of, there are administration officials that use the term de-risking and use it pretty openly and for a particular purpose. I think that I don't have an issue with. I think the two things that I would say to kind of branch this out a little bit more is, one is de-risking, which on one level you could say is either, is it merely subsidies or is it something more? And by subsidies, I'm including grants, loans, tax credits. Is it generally bad? Is it per se bad? Or is it actually like the theme of this panel is varieties of de-risking? Are there versions of it that actually have a lot of legitimacy? And I do think there's something, Danielle, in your paper that kind of does ring a little bit, like we have a little bit of splitting off point of what maybe Larry Fink and BlackRock might want for their investment products, financial investment, portfolio investment, is like very different from how the IRA is structured, which does not go through finance. There are obviously some financial beneficiaries from investment, inevitably, in sort of private sector, in the private sector. If you subsidize it, some shareholder and bondholder is probably making money from it. But IRA is not structured as something to go through BlackRock. And I kind of would contrast that with, say, how the dream of the 2000s US housing bubble and bust worked, was actively celebrating the de-risking of financial products as a way to intermediate more capital towards housing and home ownership. That is sort of the, when I hear a lot of this stuff around like central bank and the macro financial architecture, it's probably fair to say that IRA is not trying to go up against the Fed or trying to change the relationship with the Fed, but it is trying to, in some ways, bypass it. That makes more sense, right? So that's the thing. It does seem to me there's a little bit of a splitting off between a lot of those types of de-risking approaches that are rooted in, if we de-risk this financial product, we'll get more financial inflows and that will lead to more fixed investment, versus we're going to subsidize the fixed investment. That's not to say that there won't be financial beneficiaries, but there is a sort of breaking off point here. And I think gets to two very different kinds of de-risking. We can discuss the legitimate benefits and costs of both separately, but I think that is like sort of a categorical difference. I'm kind of curious, Daniela, how you sort of make sense of that.
Chirag, did you want to also say something in response to Daniela, and then we'll turn the floor back over to her?
So I think I'll start actually, I think, Daniela, with the pieces of your de-risking definition from your the European de-risking paper, and there are pieces of it that I really like. One of which is, I think, this concept of the production of investability, and I think whatever we end up defining de-risking as, I think it is important to acknowledge that investment as such in certain sectors could happen under the right circumstances and often does not happen. And we should be asking why. And once we can provide a solid answer, perhaps act on those reasons to make certain kinds of investment possible. Where I think I would quibble a little bit with the definition is that I think the production of investability happens both for private actors and for public actors, right? There are factors that prevent public actors also from undertaking investment, and if those can be removed, mitigated, altered, I guess in some sense you've de-risked public investment as well. And I would also note that, so far as this is your term or not, that's that I will leave aside. But I think in certain cases, the public sector is not dealing with so-called risks, things you can assign probabilities to or try and hedge against using interest rates or the pricing of capital or subsequent gains from the investment. Sometimes what the state is doing is it is trying to create a sort of certainty around capital accumulation that public or private actors can then act upon to make an investment in the first place, right? If you look out at an investment vista on a particular product, and as a firm or as a public enterprise cannot distinguish or cannot identify the opportunities that would allow you to translate that into capital expenditure, that investment just simply will not take place. There's no risk there at all. There's not even an identification of the possibility spaces of investment. And so I would add that as well. And what the state is often in certain cases doing is certifying lines of activity as possible for accumulation, either by private actors or possible for capital expenditure by public actors. And I think the last thing that I will note is, at least in my understanding of this production of investability, I do not at least hedge it on the use of the price mechanism, right? As I noted before, these barriers are of a kind where they often prevent any sort of price system for compensating for the existence of those barriers in the first place. I mentioned interconnection, but I could also just critique a carbon tax on this basis as well, right? A carbon tax functions on the idea that if you put a price high enough on CO2 emissions, that might itself spark investment in alternatives so that substitution effects can take place. The problem with this, of course, is that the carbon tax might not address any of the actual barriers to undertaking certain kinds of capital expenditure in energy as well, right? And so in certain cases, the state is dealing with factors and barriers where price signals have not either yet come into existence or are even relevant to certain kinds of investment considerations. And so, you know, we can talk about planning, we can talk about industrial policy, but you know, we're talking about a space where I think activities are made possible or not made possible.
Great, Daniela, do you want to respond to that?
Thank you. I mean, yes, this is fascinating, and I'm going to go to Skanda last, because maybe in some ways that's the more difficult question, or maybe answering the points around why do I understand de-risking as an intervention in price signals? So I would argue that, I mean, I define de-risking, and I would say that this is how European, for example, how European technocrats and politicians think about de-risking at the fundamental level. De-risking is about steering price signals without fixing them, right? So you don't have price controls, you don't deal with inflation in you know, some kind of muscular state version, but it is about steering price signals and steering them to even where they don't exist. So for example, we have in Europe, and I'm writing about this, you have the Germans creating a green hydrogen market where it didn't exist before, through a series of de-risking measures that basically, you know, compensate private investors for, or reduce the uncertainty of the price signal for private investors. So I'm very comfortable with sitting or standing behind that definition of de-risking, because that also helps you kind of be a bit conceptually clearer about the fact that, you know, the de-risking is about a relationship between the public and private capital, between the state and private capital. The state cannot de-risk itself unless the state offers or has companies that operate as market companies. In some ways, there are examples of the Danish state-owned or Danish ownership of 51% of companies like Ørsted who are doing energy infrastructure. So I am not, I think it confuses things to argue that somehow the state or there is a public to public de-risking. To me, de-risking is about shifting some risks from the private sector onto the state balance sheet, and not just by fiscal measures. Regulatory measures are very important. And the World Bank from the beginning, and the UNDP and the Deutsche Bank, when they describe de-risking, they emphasize the importance of regulatory de-risking as in removing obstacles to the formation of a price signal and to the formation of the market. So I think we have to be very clear that this is how I use de-risking, and this is how most people use de-risking. I don't think anybody goes around thinking the state de-risks itself. I think the question of the state is important, and I want Melanie to come and talk about this at length, because she's writing some amazing stuff. I mean, as somebody who has grown up in communism, I remember state companies who did not care about price signals. We can argue whether state companies should care about price signals or not, But there are the models of capitalism where there are certain areas and sectors where the state companies do not care about price signals, and in a sense they buffer the end users, whoever those are, from the consequences of market volatility. So I would say to continue to use this definition of derisking as steering without fixing price signals, because that is, in a sense, and that takes me back to Skanda's point about what is the central bank, why is this a central bank story, and why industrial policy is not going through, because it's not going through BlackRock, is not derisking. So, I mean, you are correct in the sense that BlackRock is not as important as a political actor. Obviously, I mean, I would say, BlackRock sent somebody to write the IRA in the Biden administration. It's a different kind of power of ideas process going on there. But to me, the IRA, and this is why I make the difference with the CHIPS Act. And I'm very interested because obviously the CHIPS Act much better, and the dynamics of the US IRA versus CHIPS Act much better than me. But to me, the US CHIPS Act moves significantly away from the logic of derisking, because there it says these are strategic state priorities and you have to achieve them. And we have seen this, and I wanted to go, I'm hoping that we will have time to go to the question. There is a question number 7, guys, where I was going to talk about this in some detail. But we have to also remember that the US IRA embracing of a relationship between state and private capital, which basically steers price signals and makes investability. And I'm not saying this is a smooth process, it sometimes fails. There is no, trial and tested process that says if you steer it with this amount, then you will get exactly. And that's, to me, is a critique of derisking. But the IRA, what it did, it also changed or displaced, for a variety of reasons that we maybe can explore. It displaced European approaches or European intents to create a relationship between the state and private capital that included a lot more stakes, or included the discipline of carbon capital. And this is something else that we have to remember when we discuss about the US IRA, is that it's not just a question of greening or incentivizing private investment or incentivizing private manufacturing of clean tech, but it's also a question of shrinking fossil fuels, shrinking carbon capital. To me, it's a very different story from the standard story of industrial policy in the developmental state literature for that reason. I'll stop.
Thanks. That was very clarifying, I think. And I'm sure if we possibly have time, everybody has much more to say on this topic. Maybe that question should have been the whole panel. But we do want to we do want to get to the other topics that I had on my list. So I wanted to ask Melanie, sort of leading right into this question. Daniela, you said, this, from your point of view, the IRA does not represent any sort of paradigm shift. And I wanted, because Daniela wrote a I thought, very compelling piece, kind of weighing the arguments on this question. What was the name of that piece? Anyway, we'll put it in the chat. And so I was hoping you could kind of take up this question of whether, in fact, or what kind of evidence or what kind of arguments we could make on either side of whether the IRA and the CHIPS Act and the various, analogous measures being contemplated elsewhere do constitute some kind of fundamental shift in the intellectual climate. Is this at least a step in the direction of a broader substitution of public planning for market coordination, or maybe that's just wishful thinking by those of us who would like to see that kind of shift?
Yeah, sure. And I might take a bit of a circuitous path, likewise, doing a little bit of post-Keynesian throat clearing on what I think the decarbonization problem is and how we need to address it. So as several people on this panel have already said, I think that we're kind of in a moment where there's more acknowledgement or shared understanding around decarbonization being a problem of investment and divestment. So we need to very rapidly and at a spectacular volume transform existing capital and infrastructure stocks through investment and divestment, and also be expanding that. And I think here it's really important to stress that when we talk about investment, we're talking about capital equipment installation, not necessarily financial flows. And so when thinking about how we're going to achieve this, the paradigm for so long, both in terms of policy prescriptions, but also just kind of like real implementation, has been to let market coordination more or less take this over. And by market coordination, I mean primarily relying upon private investment subject to the constitutive elements of private investment, which is private profitability and the liquidity preference, which both guide private investment, but also can hinder it in terms of the multiple criteria that we're trying to address right now. But then also market coordination is a fundamental issue for decarbonization because, and I'm borrowing the language of Yakov Fagan in a very like Leon Schiffian vein, but the fossil system and the renewable system, both economies and like energy systems, are very complex integrated machines, and you can't just swap parts from one to the other just in a kind of like straightforward way. It's a very incongruous system, so you need like synchronicity of investments to make sure that we don't just have like mass economic turbulence, both in terms of price and stability and just fundamental like issues with our productive systems, but then also thinking about how do you like build a coherent renewable energy system and an economy on top of that. I think market coordination fundamentally can't do that. So what would be different about non-market coordination? Well, I think to start would want to always stress that regardless of the decarbonization imperative, economic democracy is an end in itself. But then thinking about the decarbonization imperative specifically, what we would want to see, I think, is for public coordination to take over through institutions of public investment, public asset ownership, public enterprise, and pluralistic decision-making, which would deliver investment and divestment directly by having the state undertake essential activities and investments, and then coordinating amongst public institutions and private actors. I think there'd also be a much stronger hand for state bureaucracy to like macro and macrofinancially manage the transition in terms of like price policies, moving away from monetary dominance, which I'm sure we'll address later on as well. And then more broadly, embrace the risk-bearing capacity of the state through public ownership. And here I would like to provocatively, poke my God, Danielle Gabor, to flag me alive by calling this potentially democratic de-risking. And by this, I mean taking whole sectors into public utility models, or also having systemic public options for capital investment in order to stabilize and expand green production networks and also to stabilize green industry. So I think here very definitely public electricity generation, but you think of also like other bottleneck industries. And then thinking too from a resilience perspective, the need to have capacity maintenance, which I think will kind of necessarily entail the state balance sheet in a kind of equity-like manner. So when thinking about democratic coordination, I think evidence of like moving towards that, or kind of realizing that, would be institutionally moving towards a green mixed ownership economy where you have like much more systemic public ownership, as well as mixed economy models, such as like using equity stakes, not just to passively subsidize private investment, but to have really strong control rights. And so where are we in that configuration through the IRA? I think this is where I both agree and disagree with Daniela in some regards, because I think, as many people have noted since the IRA's passage, it is a really spectacular volume of subsidies being handed out to private capital towards private capital expenditure. And what's, I think, both compelling and tantalizing, but also quite frustrating, is the structure of it is leaving the actual undertaking of capital expenditure to private actors, which again suffers from all of these issues that I've just addressed, even with pretty robust subsidy. And so I think that it's right to point out that this is a continuation of this logic of producing investability, or I love the phrase that the economist Tim Barker has revived, which is bribe to capital formation, which just, again, just the fundamental issue is leaving this to private decision making. But at the same time, I do think that it's really important to stress that we have moved in some ways quite strikingly in terms of real policy towards concern for capital expenditure, which to me is very different, as Skanda had said, from this like, how do you get financial actors to do certain things? It's like a very different animal, I think. And from there, even though there are substantial pitfalls to that, both in terms of like policy and rhetoric, I do think that for elite policymakers and just kind of this intellectual community, the shared project is trying to manage and coordinate this boom. It's kind of like we have these like subsidies floating out there in the ether that could be undertaken, but it's still so subject to further public investment and coordination that I do think that this is becoming the shared framework of future policymaking and experimentation. And I think that that's the terrain that we need to be entering into in order to like really seize that opportunity. But I'll stop there.
Skanda, did you want to say something briefly, and then I think we might have to go back to Daniela. She wants to comment since So much of this is directed to her.
I'll try to keep it somewhat brief. One thing that comes out of Melanie's comments, and I think is worth thinking about in this context, whether you take the de-risking frame wholesale or you have issues with it. I actually don't have a problem with de-risking as the term of art for how we talk about all this stuff, because yeah, you are doing a form of de-risking with the IRA, even if it doesn't run through BlackRock. Primarily through, I mean, BlackRock surely benefits. I'm not trying to deny that. But I think the part that success Melanie is like, we need a certain kind of fixed investment, right? There is a kind of fixed investment that is necessary. That fixed investment left to the private sector's devices tends to be, even at once as it has a social value to it, tends to be a free cash flow drain, right? Investment itself tends to only be justified if it overcomes certain hurdle rates in the private sector. And that is a kind of risk calculation that you can think of as, I don't actually think of that as being the price mechanism in the same way that, say, carbon price, when we talk about the price mechanism there and price signals for carbon. That's the context I'm more familiar with, how we talked about the price signal mattering for climate change, whereas we're talking about actually getting fixed investment through the door. That is a place where there is a kind of de-risking logic that's definitely there. I think that's actually very accurate. What I have is, like, I think this is actually going to be quite necessary in a lot of areas where investment is subject to a lot of uncertainties, where it's actually really important for the private sector to start trying. Again, one good example of this would be like Cleveland Cliffs, which is a steel producer in the US. Because of the tax credits that are available with trying to, steel obviously is very emissions intensive. We don't have scalable, tried, true, tested solutions for how we're going to get to emissions-free steel production. There's obviously like a lot of smaller scale prototype sort of solutions that should be able to scale, but we don't know. And we need to get at some point the ability to scale that up. I think of IRA incentives and IRA de-risking in terms of those types of tax credits. It's actually very important. And in substance, if you can change industry behavior to try things that drain their free cash flow in the short run, but I mean, they obviously get potentially returns in the longer run. But if you have changed behavior, that's actually really important to changing the system itself. Now, there's a lot of reasons why IRA looks the way it does because of just like US legislative procedure, in terms of there's going to be a lot of things that are through financial mechanisms and not through regulatory mechanisms just to get through reconciliation. That's a lot of legislative inside baseball. But like, let's make sure we focus on the substance over the form, right? Whether this takes a form of a lot of, and in some cases, yes, these are juicy carrots. These are things that are meant to be very sweet and very attractive for private sectors to engage in. But the ultimate goal is to get them to change behavior. And that is like for a lot of places, that's actually going to be vital and necessary. And it's why I kind of take I have the biggest concern about how we sort of paint with the de-risking brush, like how broadly to paint with it and how broadly to paint with it pejoratively. Like, I think I can definitely come up with examples where de-risking can go wrong. But there's actually places where it has like a legitimate purpose in the sort of energy transition, sort of how are we going to tackle this challenge, and it does have some legitimate purposes. Sorry, that's so long.
Yeah, no, that I think was very, very clarifying. And Danielle, I know you've got a lot to say, but maybe if you could just, at least I would appreciate it if you could kind of address this point that Melanie and Skanda brought up, which is, can we separate de-risking as a descriptive term from de-risking as a normative term? Is there a space to imagine a democratic de-risking? Is there a space to imagine a de-risking paradigm of economic management that is nonetheless serving, broadly social, meeting genuine social needs to a democratic political process? If we think, carrots versus sticks, either way, you are hopefully getting the mule to move where you want it to, whichever way you're inducing it to do it. So it'd be great if you could take a couple minutes and kind of address that.
I would say the short answer is no. With the due respect, I like the idea of democratic de-risking, but I think it's fundamentally inconsistent with how I understand de-risking, which is trying to change behavior without, and I think Skanda is right in the sense that we I'm going to park for a second the bigger question of can we do or should we expect to do the things we want to do about the climate crisis through private capital? That's a very big question, and I'm not sure that the answer is yes. But even if we say yes, we should try to do it with private capital. It was interesting to me to listen to Skanda kind of explaining, and we agree on trying to change behavior of private capital. But I have to say, if you had lived in Europe and followed closely, and this is why to me, de-risking is a macro-financial issue, it's not just an industrial policy issue. If you have lived in Europe, you would have seen for the last 5 years, the European Commission and European governments trying to change behavior through discipline, through penalties. You can change the cost of capital. You can stimulate fixed investment, not just by making it nicer or more rewarding or increasing returns, but by basically making it far more expensive or to invest in dirty assets. So there are different kind of pathways to changing behavior of private capital. And my worry is with the US IRA, we are moving very fast away from what we had in Europe, and there are so many problems with that. We can spend a lot of time. I'm not saying it was perfect. It was very problematic in many ways and very open to political contestation and watering down. But in Europe, we had the ECB trying to discipline fossil capital and change risk-return profiles and change investability and change behavior through penalties on dirty credit. We had the European Commission doing the same, and I detail this in the paper. So I don't think we have to go to democratic de-risking. That's a kind of moving the goalpost in a direction that we would like because we like democracy. But I prefer to stay with the harsh reality of where we are now. And the harsh reality is that you can change behavior, broadly in 2 different ways. And we are now going with changing behavior in a way that BlackRock would like behavior to be changed by a lot of carrots and not enough sticks. So if you can, I don't know if Skanda wants to respond to this or any of you, why is it that we don't do the European version, right? Why is it that we are not having a debated conversation of what was the level of haircuts on shell bonds that the ECB was willing to contemplate in its unconventional corporate bond purchase program? That is to me an equally interesting conversation. But we are not having that one. And I think that is the political economy of de-risking that kind of takes us into the...
I want to let Melanie go in first.
Yeah, I think I have 2 points or to address the 2 pokes that you've done, Daniela. One on the discipline and European discourse, and then also on what I think is like an issue with the de-risking language in terms of public and private actors and governing investments. So with the discipline first, I do think that it can be tricky to talk about the role of credit guidance and the sort of greening the financial system, because I think that it is quite necessary as like a tool in the macro financial toolkit of the transition. But so often I think it's really overplayed how powerful both positive and negative credit guidance can be in terms of driving capital expenditure and capital divestment. And I do think it's really important to stress that the imaginary that through penalizing carbon investment through the financial system will have a really orderly divestment from fossil fuels, I think is like unhelpful. I think that ultimately the phase out of fossil fuels will have to happen on the state balance sheet because you have to maintain a certain level of capacity, but then phase it out exactly. And so I think that there's a role for credit guidance there to be, spurring that along, but it's not the like actual fundamental mechanism through which that'll happen. But then I think too, what I see is the kind of issue that we're circling around when talking about de-risking is like the role of like what should be publicly invested in and what do we think we kind of like can only have private just because of where we are politically in the current moment. And I do think that that's where I think the language of de-risking can still be quite helpful as we turn from financial market shenanigans into actual like governing capital expenditure, because I think that kind of following a very post-Keynesian logic, you can, tell a story of how, or for example, with renewables in the UK, for example, the contracts for difference model is kind of this classic like de-risking. It's backstopping private investment, but there are some issues with it currently where in the face of inflation and higher interest rates, wind turbine developers, for example, are saying that they need to raise their prices, otherwise they can't expand capacity because their profits have been eroded, because you have private generators who are like, feeling a lessening of subsidies through this contract creation model, often called like a reverse auction as well. And so kind of like in this space where they're fighting for profit share and like, which capacity do we want to be expanding? If we want to like govern the capacity to produce, to privately produce wind turbines, then public generation, de-risks that investment and stabilizes that production network. And that's why I think, just kind of point being, as we move into, real stuff and fixed capital investment, I do think that there's a way to be appropriating this language of de-risking. And I don't just mean to say that as like a provocative thing, just because Danielle's in the call. I actually don't really know of a better term for it. So if you have one, Danielle, I'd love to steal it, but.
I wanted to get back to two things that I think one thing that both Melanie brought up and Daniela brought up that's kind of, I feel like, just worth parsing a little bit further. Again, financial investment and fixed investment look very different, both in terms of what your ultimate outcome is. Like for decarbonization, which is a real phenomenon that we're trying to change, decarbonization is actually about the real stuff and real capital stock, both for divestment and investment purposes. And it's trying to change that. And I actually think there's a little bit, the de-risking logic is in the financial context to say we're going to de-risk these financial instruments and we're going to penalize certain risk financial instruments. Strikes me as one of the more flimsy aspects. It's set aside even the normative aspects of whether it's good or bad. The notion that this is going to be a key lever for how we're going to drive fixed investment in certain directions strikes me as it's generally been a reach. I guess I'm happy to be persuaded otherwise, that it actually is effective. But in the actual math of how much oil and gas and coal investment you get and how much investment you get in all these other things, I'm not totally convinced that there's been a big drive from finance to fixed investment outcomes. And that's been tried in a lot of different contexts where I feel like it's failed. That's, I think, a running theme of the last few decades, where this notion of if we just give finance certain conditions, it's going to lead to certain fixed investment conditions. And I think that's part of where I said the varieties of de-risking, we kind of need to start to parse that out a little bit further to really make headway. Daniela brought up a point that I wanted to get back to, which was about chips and how chips is maybe a more constructive example. I don't really see it. I don't really see how chips is that much different from IRA. It was largely lobbied for by the industry. It's not a case of, yes, I think there were some Republicans and Democrats who saw the national security benefits of having an industrial base around chips, both leading edge and some legacy aspects to it, which I think are legitimate. And I think there is definitely room for both the public to want something and the private sector to want something, and it may align. I don't think that's impossible to happen. But I don't think that this is actually that different in terms of governance design. And, yes, there are some strings attached, as there are strings attached to certain aspects of there are conditions to be met. Conditionality itself doesn't remove the fact that these are largely grants that support the investment aspirations of semiconductor manufacturing companies. And so I don't think that that's a very useful, I noticed in your paper, you kind of try to say that might be something different. It may be disciplining of firms that's happening. I'm not sure I really see it. I think it's largely at best it's collaborative, and at worst it's mostly a set of conditions to try and make sure that firms invest a certain amount. But it's not, I think you can say that's industrial policy. You can say it's a de-risking industrial policy still, because it's largely grants and subsidies. We're not talking about stuff that's really going into a really sort of a new regulatory state here around semiconductor manufacturing. So I'm pretty skeptical of that. And with that said, I'd be curious, Daniela, in terms of IRA, if it wasn't to take on the sort of more pejorative de-risking structure that you kind of layered on, what does that look like? What would IRA look like where you would say this is something more fundamental in terms of a term? Am I
I think Josh is still in charge, no?
I was asking you if you want to respond to that. Otherwise, there's a couple other topics we can move on to.
Sorry, I'm happy to respond, but I don't know if Chirag wanted to say something. I didn't want to just be.
Yeah, Chirag, just let's.
Yeah, so I'd actually I want to add on to something that both Skanda and Melanie had said, which is this concept of discipline. I think the reason I focus so much in the beginning on the production of investability feature of the de-risking definition, and I think of industrial policy more generally as creating possibility spaces for investment, public or private, where none occurred previously, because I think it clarifies the functions and the task of different policies that are undertaken. And I think actually reduces the salience of the carrot v stick differentiation, or the carrot v discipline differentiation, because I think one of the things you notice when you start to look at how policies end up sparking capital expenditure or not is you start to miss the point where the policy itself goes from being an inducement to being a discipline device on capital. I mean, one example I can give is not even a specific industrial policy, it's the American Rescue Plan, which the American Rescue Plan, by creating circumstances where there was higher employment, the economy was running hotter, nominal growth trajectories were more sharply upward than they otherwise would have been, created circumstances where firms in general, I think, looked at capital expenditure more favorably than they might have, and that there was extra pressure on them to consider certain kinds of capital investment that they might not otherwise have relative to what they might previously have done with free cash flow. Right, either disgorge it in the form of buybacks, return it to shareholders somehow, or just not use it and have it be sitting on their balance sheet. That was in one sense an inducement because you're giving firms potential customers and potential profitability opportunities, but it's also a disciplining device in that one aspect of financial capital that might have demanded a use of certain cash flows became relatively a little less powerful in being able to call upon what firms can do. And other, I think, industrial policy or more specific industrial policy devices can be thought of in this way as well, right? If you open up a large opportunity with carrots for firms to do something that they might not have been able to do without those carrots, then you open up a space where capital at least has to consider it in a way that it didn't before. And if it goes ahead and does it, you've opened up an opportunity space that was not there before. So I think in some sense, the distinguishment between what discipline does and what carrots do begins to be lost. And I think I would echo Skanda's point that there are certain devices we consider to be discipline on capital that actually end up having relatively minimal effects on whether capital expenditure is undertaken. Skanda talked about some of the financial mechanisms. I talked about the carbon tax previously, but I think that can apply to other kinds of quote unquote disciplinary policies. We have to ask how they are opening up investment spaces that they were not before. And I don't think it's as simple as they barred an oil and gas opportunity or made an oil and gas opportunity much more expensive than before.
Okay, I'm assuming Josh is nodding, so I can take over. I mean, I would just want to say to Chirag, I mean, we can play language games in which everything sounds like conditionality or discipline for private capital, but I'm not interested in that. We can have a broader debate around, or maybe we don't have time now. I think what I would want to stress, in response to both Melanie and Skanda, I agree. On some level, I agree that, putting penalties that change risk returns on dirty assets is in a sense also playing with a price signal. And yes, it doesn't take us into the state controlling closer the pace or the nature of credit creation. But I also have to say to you that the excessive amount of lobbying that I have seen in Brussels and in London against these measures makes me think that there is something at stake that we should not discard simply because, it doesn't take us into a universe where the state is much more powerful in terms of disciplining private capital. And I've seen, and I will come to this. I mean, maybe, I don't know, maybe we'll have to get the colleagues, the Jane Institute, to organize another session where we kind of fantasize about ways in which we can discipline capital, because that seems to be difficult to do. But in the paper, drawing on the examples, and this is something that obviously needs to be developed more. And I think I really like, I hope, Skanda, you do some work on varieties of derisking that, opens up a little bit of space. I don't want to use it pejoratively. My observations simply have to do with the fact that it both this kind of logic of statecraft both accommodates a lot of greenwashing that is inconsistent with Paris targets, and I worry that it doesn't take us where we want to be for reasons that Melanie pointed out. When market conditions change, then you might have some private actors changing their mind, and we cannot afford this to happen. And the developmental studies literature already recognizes that this has been the case unless you have, and I use in the paper drawing on that literature, I use the notion of both the close control of credit. So that would mean close control of credit flows means a lot more than credit guidance. It means the state has to do a lot more work, and I'm putting the politics or the political impossibility of this aside for a second, but the state has to do a lot more work in terms of taking over or restricting the free flow of capital across borders and within borders, and changing the nature. And this is why, to me, decarbonization is fundamentally a macrofinancial issue, because we need changes in the structures of finance and the logic of finance, structural reform. We used to talk about this in Europe for a long time. We don't again. And institutions of coercion, I'm interested that you think, Skanda, that the CHIPS Act doesn't do that, because I was very dismissive of the CHIPS Act, and then the Twitter conversations, I'm sorry for bringing Twitter in, but Twitter conversations have persuaded me that there is some element of discipline in there to some extent, and I looked into it, and it's true. On this level, it is very interesting that the Biden administration is far, far more ambitious than what the European capitals in the European Union and Brussels together can come up with in terms of, if I understand, operational milestones, restraints on share buybacks, prior due diligence. These are not a lot compared to what could be done, but they are still relevant. I'm interested that you dismiss them. I don't know if you dismiss them on political terms or in terms of, will they achieve what we want them to achieve? And the purpose of, and this is to me, and I'm going to finish now, the purpose of having institutions of coercion or institutions that discipline, and this is a question of state capacity, and we're coming to that because that's another hill to climb and it's very steep. But you have that when you have strategic industrial policy, because you want to make sure that private capital doesn't go into another direction when things change or market conditions change. So that means you have to be very closely controlling or steering or holding them in order to make sure that this is that your strategic ambitions are achieved. And to me, the CHIPS Act does a lot more than the IRA in terms of saying, for what that would look like in the IRA, the IRA would say you cannot shift from small electrical cars to electric tanks, EV tanks that people will want to drive, and then you have the same problem of climate change, but with like plug-in electricity rather than fossil fuels. So that to me is the question: are we really generating? Is this just is there any meaningful hope that the IRA will not basically just increase the carbon footprint of what looks like green industries?
Yeah, I want to take a bite of that. I think part of what may be going on here is, is looking at Europe versus US differentials in the context of climate and the context of semiconductors might reveal more of a difference. But I would say the difference between CHIPS and IRA strikes me as more similar, and I'm not impressed by I think a lot of the operational milestone, a lot of that sort of planning. You can look at a lot of the DOE's work around the Loan Programs Office, the commercial liftoff reports, trying to stand up certain kinds of projects, making sure those are actually achieved. These are places where I think they look quite similar, like the Department of Energy versus Department of Commerce. The kind of work they're doing you call it maybe a form of indicative planning. This is the kind of stuff where you're trying to make sure that it's probably not with a strong, firm hand in either case, but is pretty conscious, or at least trying to gain a certain level of consciousness about how industry is evolving and making sure that it is achieving the goals it's supposed to achieve, whether that is on supply chain side, commercial development. How do we actually make certain technologies more viable so that it actually facilitates the transition? There are other aspects of IRA, right? Like there are a lot of grants, there are a lot of loans, and there's like uncapped tax credits. And the uncapped tax credits, you can say that probably some aspect of it, it is kind of it is the hope that a certain very juicy carrot, especially if left uncapped in the way that Tim described bottomless mimosas, will lead to the kind of scale of investment that may not have otherwise been grasped in terms of U.S. Congress's ability to appropriate money directly. So there's some aspect of that. But I think that latter part, I think to your point, could those incentives be misaligned? Could those incentives, like, ultimately, if the hope is that electric vehicles are going to save the day, you may be left with a lot of challenges associated with electric vehicles. I take that at face value. But otherwise, I think your point about chips is, yeah, I get what. It's not as if there's no conditionality, but your point about language games, like I think the de-risking term is fine. I think it's actually like a perfectly valid term. And I'm not really interested in the language games around saying this is not de-risking. I think it's more important to say, like, where is de-risking more appropriate? What kinds of problems do we actually need? What kind of risk does it make sense for the state to actually take off the private sector's balance sheet, and in exchange for what? Right? Like, so that I think is the more productive conversation to have, and probably a place for a little more disagreement. But it's like, there are places where there is a need to take certain types of risks up because private sector cannot absorb certain types of risks. Sometimes it's technological risk, sometimes commercialization risk. And in general, private actors only want to invest that which is capital efficient, right? That is part of there is a propensity towards capital light business models because it retains more free cash flow. There is more liquidity preference. And I think that's something to really reckon with, because in some cases, the thing we want is investment, and the thing that the private sector, left to its own devices, does not want is more investment. And that is actually the point of tension. Now, that's not always the case, and just because there's more investment doesn't necessarily mean it's the right kind of investment. But I think that's like the way I would at least say where de-risking actually has a really powerful role to play, and I don't view it as a negative thing. Anyways, I want to let Melanie also jump in.
Yeah, I think as Daniela says, we're going to need another panel at least to explore all this stuff more. But in the time we have today left, I do want to make sure we're not entirely US focused. And so I was hoping, Melanie, you can say, of course, whatever you want to say, but I was hoping you could talk a little bit about whether to the extent that the US model, to the extent that we think there's anything valuable in it, is relevant for countries elsewhere, particularly the UK, which is obviously where your background is, or the EU. Is there any, like, a future Labour government? You know, can we say there's something in the IRA that they might try to build on, or would you hope and expect they'd be pushing a very different kind of model?
Yeah, so before jumping into that question, I did want to chime in on Daniela's point about discipline, I think in a different tack than others, which is that I think that I view the IRA and chips as being quite similar, but from the sense that, to me, bribing to capital formation versus disciplining to capital formation might entail more like juicing profits for private entities, but it's still fundamentally leaving investment and economic activity to private decision-making and private actors. And I think when thinking about the decarbonization imperative, that's exactly what we can't do. And so again, we need to be in the space of thinking about public enterprise, public investment. So maybe the next panel should be on the varieties of state enterprises, from full corn-eye to full, fully marketized SOEs. But to that effect, thinking about context elsewhere, I do think that in the wake of the IRA, there's of course been a lot of activity in the European context on how to respond. And I think that at first in the European Union terrain, a lot of that had to do with the trade aspects. But I think that also is quite political in terms of actors that wanted more fiscal spending and more industrial policy saying that we need to respond in kind. So I think there's a little bit of like internal politics there. But I think that the EU's response with the GDIP is largely, a non-response at this point in terms of it just has like no money, no institutions. But then thinking about the UK context, there is a really exciting development with the potential of a Labour government because it has, like Keir Starmer's Labour Party has pledged to spend upwards of around £300 billion across 10 years on its Green Prosperity Plan, which is still largely undefined, but it does feature a commitment to create Great British Energy, which would be a public renewables generator, which they've repeatedly said that they want to be a green energy superpower akin to EDF, which is a quite large SOE in the French context, and then also creating a sovereign wealth fund with a green mandate, which would be kind of one of the rare sovereign wealth funds in terms of being a development institution closer to the NIA proposal in the US context than a purely just like taking equity stakes elsewhere to like have passive like wealth generation. And I think in that context, in terms of what would want the US model into that context to be, would be one, I think learning from the coordination problems that are already emerging from the IRA implementation, where we do have this large spending envelope, which I think is like a change from how where we had been under the Obama administration, for example, but at the same time actually allocating that money and like planning it and actually like being in markets in the productive apparatus to know what to do and to actually undertake activity, I think is a real problem. And so even though they have these institutional commitments, I think it's important to both maintain pressure to maintain ambition on those two existing commitments, but also to be pressuring for the creation of like further institutions in some of these key sectors like housing, for example. I think it's hard to imagine how they're going to decarbonize the UK housing sector, which is a huge problem. It's kind of like comical, but not how like drafty and leaky and like carbon intensive UK housing is, without coordination of both the actual construction and supply chain of that activity. But then also I think that one lesson from the US that I'd like to see brought into the UK context is trying to think creatively around fiscal constraints. They have done like some development around the idea of public sector net worth, so accounting for like the fact that like public assets do generate revenue when thinking about debt and fiscal sustainability. But at the same time, you see Rachel Reeves and the Labour Party just more broadly in terms of leadership doing a lot of like work to say that we're going to maintain fiscal discipline, fiscal rules, blah, blah, blah. Whereas I do think that for better or worse with the uncapped tax credit nature of the IRA, what it's really trying to do is say, we have a certain investment target that we're trying to hit. How do we do that creatively in terms of institutional constraints? And I think that as there's further development of like what is a fiscal rule, I think that should be the political project in mind.
Great. If nobody has urgent responses to that, I think, Danielle, I'd like to come back to you, and then maybe we'll have a final round of everybody saying whatever they want to. In terms of the international context again, because another thing you've written about is the danger of a subsidy race to the bottom. And I think it would be interesting to hear a little more about what you have in mind there. And, if let's say, it's maybe the EU response so far as a non-response, but if there were genuine pressure in Europe or elsewhere to try to follow the US example, what would be the sort of cost, downside, dangers of that? And then maybe something you were touching on a little more that I think would be great to go back into, which is whether there was a more promising model in Europe that maybe is in danger of getting sidelined by the IRA or the IRA type approach.
Thank you. As somebody, just to respond to Melanie, as somebody who lives in the UK, I'm not there at the moment, but I live there and I have a free solar panels on my house, courtesy of the Conservative government, which is kind of unexpected. But I would say I would not be as optimistic as Melanie, but you can see that this is my theme. I'm not very optimistic because the way in which I understand the attempts to create the sovereign wealth fund or the European sovereignty fund, they are set up as de-risking machines as opposed to machines for creating public ownership or institutionalizing public ownership in a way that protects or is articulated towards a more public or state-driven decarbonization project. And I want to stress this. This paper and this conversation is about de-risking, but I'm working in parallel on what I call a big green state, just as it it's a metaphor for a range of approaches, which could include degrowth or post-growth, a big green state where the state, indeed we do not allow private capital through de-risking or more discipline. We do not allow private capital to set the pace and the direction of decarbonization in the way that we are. So there I'm with Melanie. The dangers in Europe, I think, and as I understand it, they kind of parallel to the ways in which different states in the US are competing for US IRAs, but in the Europe it's far more obvious, because in Europe the fiscal the macrofinancial arrangement is far more delicate and far more open to political contestation. So what we have in Europe is now, with the US IRA, we have moved from the European Union thinking it wants to decarbonize fast, with even if it is with imports of Chinese clean tech, it now wants global market share in clean tech. In other words, industrial policy in the old traditional way of saying, you know, here and in the paper you will find, I looking through the scenarios that the European Commission says, which is kind of, it's a backward. There is a whole language of de-risking and indicators that are being created. There is a de-risking multiplier. This is the Commission's term. They say, how much would we have to bribe private investors in clean tech to get, I don't know, this 40% global market share of wind or solar? And then they come up with a number that is 80 billion, which is the most bizarre approximation of a number. But, you know, it's the politics of how much can you get from European capitals into a European level budget. I don't want to bore you with this. The difficult part, of course, is, and this is why it may not happen, the difficult part is that the European Union has a very delicate arrangement which says France and Germany and countries with more fiscal space are not allowed to promote their own industries by using by prohibiting state aid. So for a very long time, we had fights around state aid, then it was relaxed. And now what we are seeing, since the COVID-19 pandemic has hit and state aid was suspended, what we have seen is basically France and German companies are the main beneficiaries of the elimination of this attempt to impose a level playing field. And that, of course, brings with it very significant political contestation, because, you know, if you're not France and Germany, and I'm exaggerating, there are a couple of other countries that are in there, but mostly France and Germany, the problem is that the rest are saying, okay, so what about us? And this, again, it kind of turns back to the same problem that Melanie identified, that in the end, the kind of immense challenges that we have on the table, not just in terms of clean tech, but in terms of decarbonization, cannot rely on market coordination. And to me, de-risking is a form of market coordination. It brings the state in, but it's still ultimately reinforcing the logic of market coordination. What we need is big state balance sheets and state capacity to not repeat the mistakes of the Cornai enterprise. I was telling Melanie in the chat that I did my post-grad studies on, I studied how central banks live in a post-Cornai world where they have to dismantle state-owned companies. Now, 30 years later, I'm going to study how we put them back together. Super cycles everywhere.
Great. Well, we're close to the end here, so maybe we can just go around, and if anybody's got closing thoughts, I hope we will have another one of these. I hope, but maybe just start with Skanda, Chirag, and Melanie, and then we'll come back to Danielle at the end.
Right. So I think with why this sort of issue seems to be so, like, I don't know. I think Daniela's piece is very provocative about sort of de-risking and subsidy races to the bottom or top. I think of that, especially in the context of what's going to be required for decarbonized capital stock. I think there's a lot of attention that's paid to sort of divestment in general, or more long-standing. In a lot of cases, there's going to be a need for a lot of experimentation and really erring on the side of that dreaded word overcapacity, erring on the side of redundancy. A lot of countries, a lot of companies trying to figure out how to push down cost structures in a way that actually leads to more investment, more capacity to maintain relatively the same standard of living without doing much of the, especially globally speaking, without it actually involving greenhouse gas emissions. And so that erring on the side of overcapacity and erring on the side of redundancy even is part of what I think is important to at least open up how a lot of these sorts of approaches can be embraced. Not every approach. There's a lot of approaches that are wasteful and maybe aggrandize the wrong sort of political constituencies. But I do think that look, Americans will make excuses about, well, you have to get through Manchin, you have to get through American Congress, you have to get through like the reconciliation legislative procedure inside baseball. And in Europe, it seems like there's obviously a big challenge of how do you harness the fiscal policy capacity that does exist under the surface. It is institutionally constrained, it is politically constrained. But I mean, my hope is actually that those constraints there is motivation to overcome them too, in a lot of ways. I think that is not like a lot of these were poorly designed back in the early 90s and the vestiges of it still remain. And it's important to kind of overcome that because the climate's a global challenge, it's going to require, especially among advanced economies, to utilize the fiscal policy capacity that's there. And for the developed world to think about how to use its fiscal policy space to help allow emerging and underdeveloped countries to also pursue those types of paths. Not exactly the American path, but certainly not. But I think it is, we have to make that space available. I think it's actually going to be pretty critical. And I think that part of IRA and de-risking is kind of worth rescuing and celebrating.
So I can go next with my closing remarks. So, one thing I think everybody on this call in one way, shape, or form has contributed to, and I think something economics in general really needs, is a sort of a renaissance in, call it capital theory or investment theory, right? Looking into when, why, how does capital investment or fixed investment in capital structures take place? And if it is not taking place, why isn't it? And what can be done to change that if we have deemed as a society that we need more of certain kinds of investments in decarbonization, right? And I think looking at industrial policy from that frame is most useful because you can then tease out the specific functions of certain policy actions, why it is they pursued a certain course of action, what they failed to do, and what they thought they were doing. And in some cases, you will find policies that overly mistake the holding of financial assets for the act of undertaking capital expenditure. You will find policies that perhaps overly compensate executive shareholders at certain firms. But then you will also find policies whose underlying logic is we need to move quickly on sparking certain kinds of new energy generation, heating, industrial technologies. The private sector is an existing set of institutions that will continue to exist for the foreseeable future. And so we need to get them to undertake these activities as well, in many cases against their previously expressed interests and intentions. And if these policies succeed in doing that and create a boom in green capital equipment, that might well be in the near term a success. And then we would have to take political responsibility for whatever next steps that necessitates as those capital equipments are being created, installed, and are allowing for more sustainable forms of living. It doesn't mean that the fight ends there. And if, of course, there are steps that need to be taken afterwards, I think if you are looking to spark a politics of controlled, coordinated, and dare we say democratic investment, you have to be prepared for what comes next.
Great. And I think I might be cut off, so I'll try to speed through it. But I think to kind of use a point that Daniela made to make a broader point, which is as much as we might fear weak institution building and a kind of weak and undemocratic turn towards governing investment and the, supply side, productive sector, whatever you want to call it, I think that unless we're going to go the full communization route or kind of that theory of social transformation, I think you have to view social transformation as being this iterative, uncertain, and incongruous process of transforming institutions, tools, enterprises, and whatnot. And so I think on that terrain, that's just going to be the constant fight as we're kind of in the midst of this turn. And I think it's up to us to make sure that the politics of that is onwards towards the socialization of investment, abolition of fossil fuels, and the eventual flourishing of the planetary cooperative commonwealth.
Amen. What to say after this? We all hope for that. I also hope for green capital controversy somewhere in the future. I think the distinction between the conceptual distinction between financial capital and fixed capital investment is a bit too neat in this panel. So I'm going to, but it's not a place to talk here. Fiscal policy space, another political animal that we pretend it's a hard reality, but true. I thank you very much to everybody. I am a bit more hopeful after this. I'm in general quite skeptical of what's happening, but I will go with Melanie's insight that all small political changes might take us somewhere better. Thank you.
Thank you all. This has been a great conversation. Really appreciate your time.